You're listening to Mortgage Lending Mastery. Get the knowledge you need to advance your mortgage practice quickly and efficiently from Jen Duplessis, America's mortgage mastery mentor with over 37 years of experience and over $1 billion in lifetime fundings. Jen has been mentoring loan officers and realtors for over 15 years and speaking on stages across the globe. So settle in and get ready as Jen and her guests share their experience, passion, and strategies to help you crack the top producer code to reach new heights in your business. And now, here's your host, Jen Duplessis, Mortgage Mastery Mentor and head chick in charge of Kinetic Spark Consulting.
Hey everyone, it's Jen Duplessis. Welcome back to Mortgage Lending Mastery. First, as I always say, I want to thank you for taking time out of your busy day to listen to this podcast and to share your feedback with me so that I can continue to bring great guests and great content as I've done for almost 9 years now. Today, my special guest is Dan Habib. Now, you're probably going, wait a minute, I kind of know that name. Well, Dan is Barry's son. And if you're part of MBS Highway, you already know that, right? But if you're not, you now know that, Dan has been with Barry for quite some time. I've obviously been there all your life, but he's been with Barry for quite some time. He's the co-founder of MBS Highway. He's been with MBS. I think it's been 9 years now that you've been with MBS Highway, 18 years in the mortgage business. He was a Morgan Stanley financial advisor beforehand. So this all just kind of runs hand in hand. And also has been named as one of the top 40 under 40 as mortgage professionals nationally. And he's currently the executive vice president of MBS Highway. And so welcome to the show, Dan. I'm loosely giving your bio because it's just inconsequential to the fact that when everyone hears you, they're going to know that you have all this knowledge and wonderful stuff. So,
well, thanks for having me. It's great to be with you.
Yeah, it's kind of cool. And what I'm really excited about is that usually when you and I speak, we're at a conference and I'm saying, hey, where's my link? Where's my something for my coaching students, right? Because they get a special discount. And I'm always going, hey, how are you? And it's very superficial. So I'm really excited that we have, some time to have some real strong conversation about what's going on in the market, what the future of mortgage lending and real estate looks like, given the fact that today, while we're recording, the consumer price index came out a little bit lower, but still high. And I just want to get your take on what's going on in the market. What are you seeing? I obviously watch the markets all the time. And really I follow MBS Highway, but I also follow the MBA and what they're predicting. And I think their predictions were a little more aggressive in the fact that they thought it's at 2Q and 3Q of this year, we would be at 5.1 as an average, interest rate. And we're just not there yet. So they're a little off on their predictions. So just curious to see what happens. So before we get into all that, because we will, and that's what you talk about all day long, I just want to kind of talk about what it's like to be, because I always get asked this. Well, actually, I don't. My daughter gets asked this question because she's in the business now, right? She always gets asked the question, what's it like to live under the wings of mama, right? So what's it like to live under the wings of Barry, who's a dear friend as well? What's it like to live under his wings?
Well, listen, it's been both great and challenging.
Yes.
And let me explain. So, I grew up in the mortgage business, having a father like Barry, who was one of the top mortgage producers in the country on a few occasions, and, had his own mortgage company, and then created Mortgage Market Guide, where he created the sales team there, and then now MBS Highway for about the last 9.5 years. So, listen, he's probably my best friend. He's also my mentor. So, to a very high degree, I consider myself extremely lucky to have a father like Barry, because he's, one of the most knowledgeable and respected in the mortgage and real estate space. And he's been such a great teacher, and I think instrumental in my success professionally. But that doesn't come without its challenges. He casts a very large shadow. He's such a big name, and it's obviously some really big shoes to fill. So for a long time, while I enjoyed that, one of the things that I found difficult was really creating my own name and
Yeah.
trying to not be Barry Habib's son, but
Yes.
to be
As I
Dan
just
Habib,
did.
right?
As I just did. Yeah.
So that was difficult, but I consider myself very lucky because I was afforded some great opportunities having a father like Barry. And I like to think now I've done a pretty good job of trying to step out of that shadow and create my own name. And really that's just through consistency and working hard and picking up some more responsibilities, with an MBS Highway, and also doing some professional speaking out there.
Yeah.
So I would say overall it's been fantastic, but certainly challenging. And listen, my father, he he's always been tough on me, which I think is a good thing, so expects greatness and excellence, and he's quite a bit of a perfectionist, but I love my dad. So
Yeah. Yeah. I mean, that sounds like a broken record right there to me, because I've heard my daughter say it the same way. Yeah. And, it's funny because, so I want to know about the tutelage, you know, uh, she will come to me when she has to, but not as a first option. She will, she doesn't want to be a mini me. So she'll try to get her answer, and then she'll finally come to me and go, okay, I've asked everybody and now I have to ask you. It's kind of interesting as she tries to, peel away from that as well. So I think that's pretty cool. How do you find because I am talking about this relationship, and it's not just him. I'm talking about a father-son relationship in the business because, as you know, my husband worked with me for 17 years. And then when I departed and retired out of lending, my daughter came in, she got in the quicksand. And, she quickly started leading the team, and my husband took the back seat again, which he's fine doing. But there is a dynamic and by the way, my son used to work for us too, and now he's, a big options trader and stuff. But there's such a dynamic in trying to separate business from personal from business all the time. How do you guys manage that?
well, I think that it's kind of commingled, right? So
Yeah.
when
There's
we're
no
always
balance. It's just
we're
integrated.
I mean, we get a chance to hang out quite often.
Yeah.
Where he's in Florida half the year, but
Yeah.
when I see him here in the office, half the year, it's great, and we live very close to each other. So we get together a lot, recreationally or outside of work. But the conversation is oftentimes going back to work and such. So I don't
Yeah.
know. If you would call us the most successful in separating those two things, but we're both very passionate about it, and I think we have a
Doesn't feel
wonderful
like work.
relationship. No,
Yeah,
exactly.
sometimes it doesn't feel like work. Yeah. 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 I can tell you, the last time I was teaching Whitney, we were sitting on our boat, and she wanted to have an explanation of blended interest rates. I was talking about blended interest rates right now. I am with a lot of my clients, helping them understand what blended interest rates are, because rates are so low. Everyone's coveting their low rate mortgage. But the bottom line is they're going to tap into their equity. And if they're going to covet that first mortgage, the next step is to tap into the equity through a home equity line or a second. And then when that comes back to you as a refinance, a big refinance, you got to be knowledgeable in the blended interest rates. And so I've been talking to my students about this, and she's like, what's that? Isn't it just an average? And so we learned, I had to learn, but it's funny because we're sitting on the boat and I'm trying to draw it and I'm using my
Yeah.
calculator on my phone. And I'm going, this is just ridiculous. And we're, it's crazy. It's crazy. So let's talk a little bit about what's going on in the market. Obviously at the time that we're doing this, the consumer price index came out again today at, I think it was what, 8.5. I can't remember.
Yes,
But I listened.
8.5, and the
Yeah.
monthly reading was flat. So this is for the
Yeah.
month of July as we're recording this year.
Yeah. Yeah. So that's good news, because that means that the temperament is starting to, settle down. Is like we're getting out of these rough waters and we're getting into perhaps some more smooth waters for us. But what does it mean for the long haul? Because the feds have talked about raising rates. Maybe they won't now. Maybe they'll raise them just a little bit. But what are loan officers and real estate agents? What can they look forward to in the next quarter? Let's start
Yeah.
there first.
So first of all, for mortgage professionals, inflation is really the key driver of interest rates, right? So there's a lot of misinformation out there. The Fed has been hiking since March, and now they have the Fed funds rate, in a range between 2.25% and 2.5%. And a lot of people that aren't in the know believe that interest rates have gone up because the Fed is hiking the Fed
Right,
funds rate, but
right,
they are not one and the same. They're
right.
actually quite opposite, where the Fed funds rate is an overnight rate that banks lend to one another. So
Mhm.
essentially a really short-term rate. And a mortgage rate is, a long-term rate, 30 years, theoretically, right? So when the Fed is hiking, what they're trying to do is counteract the biggest problem that we face in the US economy and really the global economy today, which is inflation.
Inflation. Yeah.
Yes. So inflation was just 9.1%. After today's report, now year over year, it's at 8.5%, but it's still extremely, extremely hot. And you guys are all feeling inflation, right? You go to the store, you go to the pump, food prices are much higher. So it literally erodes the purchasing power of your dollars. But it's also the biggest directionally impactor of mortgage rates because, I'll give you an example. If I said to you, Jen, can I borrow $100,000? You might say, okay, but you're going to charge me a certain rate of interest.
Yeah.
So let's say you get $1,000. Is that return that you get that's fixed every single month? Now, maybe you have a list of goods, go to the store, you can get everything on those goods, but in the background of the economy, inflation's going up. So a few months down the road, maybe you can only get three-quarters of those things.
Yeah.
So inflation's eroding the buying power of the fixed return as the
Yeah.
investor in that bond. So you can't do anything about the loan you gave me. That's fixed for 30 years. But if
You
somebody else
sure
came to you
can
and said,
coming up. Yeah. Yeah.
if somebody else came to you and said, "Hey, can I borrow,
Yeah.
can I borrow a loan from you for $100,000?" You might say okay and agree, but you're going to do what? You're going to charge a higher rate of interest in order to combat that faster pace of erosion due to inflation. So
Yeah.
this is an oversimplified example, but when you see inflation rising, you see mortgage rates have to rise. And when inflation comes down and abates, you can see mortgage rates come down. So the Fed is trying to
Yeah.
combat this inflation by hiking the Fed funds rate. And counterintuitively, that can actually be a good thing for mortgage rates if they are
Yeah.
successful or
Yeah.
if it's perceived that they are curbing inflation.
Yeah, and I think that that's a really important point. And I love that you oversimplified it because we had a call not too long ago when the Feds actually raised it. I think they raised it three-quarters on the last
Yes.
round. And I said, whoa, we need to stop and make sure that everyone understands what's going on because so many loan officers, that are newer, let's just say they've been in the business like 15 years, all they know is low interest rates. Right.
Mm-hmm.
That's all they've seen. And sadly enough, very few, maybe three of some 40 people that were on that particular call could actually say what the Fed funds is. I said, what's a Fed funds rate? They kept giving me the rate. And I go, no, what is the Fed funds rate? Right.
Yeah, well, it's not just them, right? So the media is out
I
there, and
know. And
I
it's
saw,
scary.
I saw so many prominent media stations
Yeah.
that they said Fed hike 75 basis points. Even Housing Wire had something like this. Fed hike 75 basis points. Here's what it means for your mortgage payment. And if you look back since the Fed's been hiking, right, and
It's always
especially
a dip.
if you look the last few times, it's like really in June, it started hiking
Yeah.
75 basis points. If you look from June 15th to now, you can see what's happened with yields and with mortgage-backed security
Yeah.
prices, and
Yeah.
interest rates have come down quite significantly from the peak that we saw in June.
Yeah, I know it's crazy. And so this is where the reason I called this mortgage lending mastery is for you to become a master, not just at the product or the service, right? The conveyor belt that we have, or selling to realtors and financial planners, or guiding your clients. This is part of it. You have to know the market in order to guide your clients. You just can't understand simply the rate. And so I love that we're having this conversation. So we're talking about it, obviously the inflationary piece of this and what we think is going to happen. So now, and I have another question, but I want to just end this out a little bit. What is your take on what you feel the Feds will probably do at the next meeting? Because I've seen the Fed dots. They've changed dramatically, by the way.
Yeah.
Very,
Yes.
very different. Yeah.
So there's something called the Fed futures out there, which tries to handicap within the markets what they think the Fed's going to do at the next meeting, right? So yesterday, the Fed futures were showing a 76% chance of a 75 basis point hike at the September 21st meeting, which
Right.
is the next meeting. After today's lower inflation number, it was cooler than expectations. They were expecting 8.7% year over year. We got 8.5. That has now gone down to 40%, which means that 60% of people out there now believe that we're going to see a 50 basis point hike.
Yeah.
Now, I certainly believe the Fed's going to be hiking. If I were to put a handicap on it, I would say I think they're probably going to do 50 basis points. However, it really depends on what happens from now till then, because until
Yeah.
the September 21st meeting, we're going to get another jobs report, and we're
Mhm.
also going to get another inflation report. And speaking of jobs, that's something else I think that's interesting out there that we could discuss as well.
Yeah. So jobs, the jobs report, and I think this is okay. So before we go to jobs, let's talk about, because I want to ask, make sure that I'm asking this question and make sure that people understand inflation, right? And and recession, specifically recession, because there's a lot of ridiculous stuff out in the news. I mean, for eons, the definition of a recession has been a standard. Now all of a sudden it's a goofy standard, it's very wonky. So we know well, I'm going to have you explain, and I know what the definition is, but I'm going to have you explain it, and then talk about what you think is going to happen, because I know I love inflation. I mean, not inflation, I keep saying that, recession. I love recessions because we know that during a recession, interest rates drop.
That is correct.
So bring it on, baby. Bring it on. And my feeling is we're in it. But why don't you go ahead and explain the definition of recession and what your take is on what will happen with interest rates, and maybe your take on the fake news.
Yeah. So, speaking to that, right, you had the White House, you had Janet Yellen, and all these people out there almost trying to explain, oh, this is not the definition of a recession. So here's what it is that everybody has known forever. Even I saw a really great image that somebody sent me in the FINRA like textbook, right? Meaning when you study for your Series 7 and stuff, it says how many consecutive quarters of negative GDP is a recession. The definition forever has been 2 consecutive quarters.
Yeah. Now, well, it's not really negative.
So you had negative 1.6% in the first quarter. You had negative 9/10 in the second quarter. But now you have people coming out and saying, well, that's not the definition from the referee in this case, which is the NBER, or National Bureau of Economic Research. And what their definition states, and many have said they've kind of changed this, right? But if you look on their site of their definition, it says that you need to have economic contraction with a certain amount of depth, duration, and diffusion. Meaning you need to see a significant enough amount of economic contraction, a long enough amount, so not just like a little spurt of economic contraction, and it diffused widespread through the economy, not just in one sector. But it's just interesting to see how, people are saying, oh, we're not in a recession. And one of the things they point to is the unemployment rate, which just dipped down to 3.5%. But before we get to that, right, I want to just share a chart with you, because this will show you some empirical evidence of what really transpires throughout history, right? So if you just take a look at this, this shows you that if you go back to 1947, every time you've seen 2 consecutive quarters of negative GDP, you have had a recession. So if this is not going to be classified, this would be the first since 1947. And it shows you the varying degrees of how much we've seen combined decline.
Yeah, it's crazy because, and again, I'm telling my students, you're in a recession, tell your clients this is good news because rates are going to drop. The challenge for most loan officers is that when they say rates are going to drop, their clients pull back and say, well, then I'll just wait until rates drop, right? But there's also appreciation to consider in the cost of waiting, right? And the pride of ownership and all the other pieces that go with that as well. So, and I know that most people are, talking about fixed rate loans versus ARMs. We can talk about that as well. So let's talk about the unemployment. So unemployment, is pretty bad. And so now I heard on the news today, and I won't say what way I swing, but it's just, I flip around so that I hear everything, so that I don't have just one opinion, but I have a multitudes of opinions so that I can create my own. Jokingly, they said, well, the fact that the borders are open is really good because we need to fill jobs. I just went.
So if you take a look at the jobs market, right? So first of all, it's important to note that this is a lagging indicator, and it always has been. And there's been many recessions where the first few months of a recession, and it doesn't get classified till many months later, you actually see job growth increase, but you're still in a recession, right? And here's the thing too. The jobs report is a tricky report. So there's 2 surveys within the jobs report. You have your business survey. That's where you get the headline job creation number, which just showed 528,000 jobs created in the month of July. And it also is done by modeling birth-death ratio of businesses, how many people were on payrolls during the sample week of the 12th. And then you have the household survey, which is a completely different survey. The data is collected differently. They phone call 60,000 households, and they ask if they're employed or not. And that survey has its own job creation component. And that one showed much lesser of a job creation number, 179,000.
Right.
But also that's where you have the unemployment rate from. And it's been like a tale of two reports the last several months. If you look at the last several months, you've actually seen a big amount of job creations in the BLS headline number, and actually job losses in total in that household survey where the unemployment rate comes from. So you might say, well, why is the unemployment rate stayed at 3.6% for 4 months and then come down to 3.5? Well, a big reason for it is a ton of people have been leaving the labor force. You see the labor force participation rate at the lowest level in a year. And this report, it always intrigues me because they don't count a lot of people. So if you're discouraged and you don't look for work for the last 4 weeks, well, they don't count you as unemployed or in the labor force.
Right.
And, there's about 6 million people just in that bucket that they're not counting. There's another lesser known unemployment rate figure out there that is really like your all in unemployment rate. And that's at 6.7%, not at 3.5%. But there's other indicators I think that are a little bit better gauges of what's happening in real time. One of them is initial jobless claims. So if you get laid off from work, you get fired, well, you then go and file for an unemployment benefits for the first time. And this number is at the highest level it's been in 9 months. It's been kind of just steadily increasing. If you look at job openings out there, well, job openings were at, level above 11 million. Now they're down, to like 10.7 million. We've lost about 1.2 million job openings over the last 3 months. And anecdotally, you see this everywhere, right? How many companies, even in our industry, but
well, I was going to say most of those would be in our industry, right? I mean, every time you turn around, somebody's laying off a team, a set of something. Yeah.
But even Amazon's, Apple,
Oh yeah,
I mean,
Amazon.
Walmart, you name it, right? So those numbers haven't hit the tape yet, in my opinion. But in
Yeah.
the next few months, this lagging indicator will start to catch up. And I do believe you will start to see the unemployment rate move higher. And the other thing is not just the media, not just the Fed. I mean, Fed governors are out there saying this, Janet Yellen, Jerome Powell. Everybody is saying, well, you can't have a recession because the unemployment rate is so low. But I just want to share one more chart with you because I think this is really important, because this really showcases what happens and when recessions actually start. So recessions do not begin, and this is a little quote here. I can't see a recession with a 3.6% unemployment rate. This is Christopher Waller, one of the Fed governors.
Yeah.
But if you take a look, oops, hold on one second here. This is a chart, the blue vertical line showing you recessions and the white line being the unemployment rate. But if you look, every single economic cycle, the unemployment rate the recession doesn't start when the unemployment rate's at its highest point.
Right.
It's when it's at its lowest point and then turns higher.
Yeah.
Lowest point turns higher. Lowest point turns higher. This happened in that short recession we saw when the unemployment rate was at 3.5% in 2020. And then obviously it shot up huge because of COVID. But here we are again. And the reason why this happens is because if economic activity starts to slow, one of the first things companies do, right? I mean, first of all, unemployment rate's tight, labor market's tight. They pause in hiring, then they lay people off. And it has a snowball effect because once you get laid off, you're going to change your spending behavior. You're not going to go to the movies, the store, out to eat. And then those businesses that were relying on that, they have to lay people off. And then it shoots up quickly. But the point being here is that every time we see a recession, it's when the unemployment rate's at its low, not its high. So you can't use that as a reason as to why we're not in a recession, or at least headed for one.
Yeah. Yeah. And I think that, there was a rush, in my opinion, there was a rush to hire after COVID to get the world back on track. And I think that there was probably although it is funny, like an over hiring, but at the same time, and remember, we've got 4% of the market, 4% of all employees who left their jobs and never returned, right? Never returned. And we don't know if they retired. We don't know, there's a big piece of that is that they just retired or that they went into some other industry. But a lot of them became entrepreneurs and they're not being counted as unemployed because we also know that 75% of entrepreneurs make less than $58,000 a year. So they're not making a lot of money. They're not being included in this. So we have a lot of peripheral data that needs to be used. And this is why I think it's so important. And maybe you'll agree with me. So help me on this. Maybe. I'm not asking you to do it. But this is one of the things that I share all the time is listen to Barry, listen to Dan, listen to right-winged and left wing, in the middle wing, watch, read everything, but then arrive at your own opinion to give to your client.
I completely agree with you. And no matter who's portraying the data, right? The data is the data. So, one of the things that I like to do is not just take the headlines for granted as gospel and really kind of dig into the reports deep myself, because a lot of times they're not giving you what the true report is in those media headlines out there, no matter what source it's coming from, whether it's left or right. Obviously some people might be talking their book a little bit, but another interesting thing from that jobs report is that more than half the jobs were part-time jobs, and more than half of them are double counting, meaning in that headline job creation number, if you're employed, it doesn't just count you once. If you have, let's say, maybe to make ends meet, you have to get a second or a third job, it's counting all of those as job creations. Whereas the household survey where you get the unemployment rate from does not do that. It counts you once. So, I think these numbers are not telling the true story in the jobs picture. And again, it's lagging. So I think that we will start to see this move higher in the coming months. And I think a lot more people will get on board with the fact that, hey, we're in a recession. And even the MBER, doesn't matter when they officially classify it. I think we're either in one or very shortly going to be entering one. And to your point, whenever we go into a recession, historically, you see interest rates decline because recessions are deflationary by nature and by definition. So I do think that inflation will come down, really start to come down more significantly towards the end of the year. And there's a couple of reasons for that. There's a couple of reasons for it, right? Number one, you have the comparisons get much tougher. So the inflation reports are rolling 12-month reports. So that means when we got the one this morning, as we're talking on August 10th, well, what happens is it replaced the July number from 2021.
So it now includes this one.
Exactly. So if you keep shifting down, the next 2 months, we're not out of the woods yet, because we're going to be replacing a reading of 0.3 from last August and then 0.4 from last September. So you could still see some stuff happen depending on what happens with energy prices and such. But when you go farther out past that, when you're talking about the fourth quarter of this year, and then looking back, the comparisons get much tougher. But not only that, the Fed rate hikes, I think, will really start to bite the economy. I think this is an important thing to understand, because the Fed rate hikes, the markets can try to price in if the Fed's hiking 75, 50 basis points. But what's actually happening is they are trying to destroy the demand side of the economy. And when they do hike the Fed funds rate, while it doesn't directly impact mortgage rates, it impacts short-term rates. So your treasuries, anything attached to like SOFR, your small business loans, your personal loans, your credit cards, your car loans. So that takes time to impact and kind of infiltrate into the economy, several months at least. And you will start to see those bite and kind of curb on economic activity as well as inflation. So by the fourth quarter, and the way I like to explain it is like, if I wasn't feeling well, Jen, and I was like, man, let me go get with my doctor and get some medicine. Well, he might prescribe me some medicine, but I'm not going to take my first dose and then 5 minutes later be dancing on the tables and feeling great. It's going to take time for it to impact my immune system, much like the Fed rate hikes will take time. So I think we're going to see inflation start to really come down a bit more by the end of the year. I think we're going to be in a recession, and I think you're going to have a decline in interest rates that will get you back potentially with a 4 handle on it. And I think that's going to provide a great opportunity to refi all the loans that you're doing today.
So let's talk about that as well, because that was leading into what's happening now, is that the conversations are, get the loan, get the home, the house that you have. And we know 50% of consumers that purchased in 2020 and 2021 have buyer's remorse of the home for whatever reason. So we know people are anxious to get out. So it's not even just a refi of the ones we've done. It's also a get out of what you're in, because, now the spread is smaller, right? We're hoping for that spread to be smaller. We know that this is the fourth best purchase market, we've had in what, 20 years, so everyone's singing gloom and doom. And it's like, no, it's not. It certainly isn't. And it's a prepping time for increased activity, as people that are in the industry are here for the money and then leave. good riddance, see you
Mhm.
later, leaving all the rest of us here to always speak in terms as if I'm still in the business. It's funny, but leaving all the rest of us here, to be able to capitalize on that. But what is the capitalization of that in your perspective? And this is truly what my question is that everyone is saying, hey, we'll just refinance. Don't worry, we'll just refinance. I'm suggesting that we talk about arms. If you're going to be refinancing, let's just get you an arm, get you a lower payment and refinance. Or if you like the fixed payment so much, go ahead and pay the fixed rate. Let's accelerate the appreciation, the payment and the balance on your loan. Let's accelerate that so that when you do refinance, you're in a lower LTV, you get the best of the best rates if that's what you want to do. But I want to get your take on this whole positioning of, we'll just get a Band-Aid loan now and then we'll refinance you later. And also this is the little part that I want to talk about. I love how the market has decided that points will be the new prepayment penalty without saying that.
Yes. So great questions. So, first of all, I completely am of the belief that we're going to see rates, over the next 6 months that are lower than where they are today. Right. So one of the things my father always taught me is that you want to look at, and this makes a big difference between people that are really successful in the industry and people like you said that are kind of just here to make some money and take advantage of some opportunity, is that you need to not just look at the transaction kind of, by itself. You need to look at it 2 transactions at a time. So how is this loan going to set up with the next transaction that we're going to be doing for you? And if you believe that rates are going to be coming down, it doesn't mean you shouldn't buy a home now because of some things you mentioned, right? We're still seeing appreciation at more modest levels, not depreciation. You also get amortization, but you don't want to be paying all kinds of upfront costs now where possible. If you're paying points, and I know sometimes it can be difficult to get a 0-point loan, but you're doing things like upfront MI, all these things are going to have a break-even period that you're not going to be able to reach if we're refinancing you. And to your other point, I wouldn't be afraid of arms because you're not going to be holding on to this thing for 5 or 7 or 10 years. We're going to be refinancing you much sooner. And in many cases, you could save 0.5%, 0.75%, 1%. So it makes a ton of sense. And by the way, a lot of people don't realize it's a mathematical certainty in a lot of cases where it's going to be a better loan, not just for that time on the arm, right? So if you're doing a 5-year arm, it's probably going to be better closer to 7 years or so than just 5 years. But once again, we're going to save you money now and then refinance you into let's say a cheaper 30-year fixed rate than it's available today in the future.
Yeah. I think that's super, I just think my strategy has always been, what is our entrance, holding, and exit strategy? Entrance, holding, and exit. Because the holding strategy is how long you'll be in the home. During that strategy, you may refinance 4 times or 2 times or 1 time or never, right? And I think that's super important for clients or for real estate loan officers to understand, right? Is that there's a holding strategy you need to be looking at. So while you were saying, there's 2 transactions, I think there's a multitude of them. There's what is our exit, our entrance strategy? What are we going to do while we're holding the property and the mortgage 50 times? The accordion loan, as I call it, right? You get a 30-year loan, you mush it in, you pull it out, you mush it in. And then what is your exit strategy? All proceeds to a new house, some proceeds, investment property. What is the exit strategy out of this house? And I think if we can keep that in line, it makes the discussion about paying points and hey, if you're going to have to pay points on a purchase, that's good news. If it's a refi, it's a whole different story. But if you're paying it on a purchase, that's good. That's great news because you get the tax deduction. But my concern, and this is where I'm asking what your opinion is of this as an advisor, because I know that's what you all speak about. I know I speak about that, but as an advisor to your clients, how do we get past the point conversation, the constant point, the points, and then the escalation clauses, because we're still seeing them here.
Yeah, so
my area.
A lot of people are wondering why it's more difficult now to get like a no point loan, and it really has to do with the investors out there, right? Because I think people misuse the term like par rate, but if it was like a par loan, right, it's like, okay, it's a $500,000 loan and then it gets sold for $500,000, but there has to be some margin there for everybody to make money on this thing, right? So
time,
right, and time, right? So this loan in a more realistic market would or in reality would be selling for, I don't know, 510, 515,000, right? And then they're paying a premium for that loan, the investor, and they make their money back with the yield, with the higher rate of interest, right?
Yeah.
And that could take a few years to break even. Now, the big problem out there is that we're not the only ones that are thinking that rates are going to come down, right? So these investors are also thinking so. So there's a big prepayment risk where, hey, I'm not going to be able to get my money back.
Yeah.
So it actually, while in one case it's a bad thing, in another case it's a good thing, because it means that many other people out there are thinking that rates are going to come down as well.
Yeah.
So
that's what I love about it.
Exactly.
Yeah, it's an absolute indicator. It's an
Mhm.
absolute indicator of what is happening. So we had a conversation with my students, about a month ago, and they said, "Oh, these 1 point things," and I go, "But that's good. That's a sign. That's a good sign for everything that's happening." And that was before the Feds even raised, rates by 3/4. And I said, that's always a good sign. But it is interesting. This is the first time in my 40 years, in this 4 decades, that I've seen points disguised as prepayment penalties.
Mhm.
And
Very
I've
much.
been through the peaks and the valleys.
You know what else is interesting? I hear about a lot of people balking at, where rates are today, maybe around, I don't know, 5.5 or somewhere in that
Come
neighborhood,
on.
right? The average interest rate over the last 40 years is 7%.
Yeah.
And when my father was doing loans, at one point it was like 12 to 15% is where interest rates were. So we've seen very healthy and successful,
Yeah.
real estate
Yeah.
environments at much
Well,
higher
when
rates than
I
that.
got in, rates were 18 and a half.
18 and a half.
18 and a half. And we had GPMs, right? Graduated payment mortgages and growing equity mortgages, right? The initial NAGAM loan, the GEMs and the GIPMs. And those were starting at 14.75. And everyone thought, yes. Wow.
It's all relative, right? All
Yeah,
relative.
and it is. And I have a rate sheet that I share with everyone from April 1st of 1985, where we had finally broken below 10 on an 1-year arm at 9 7/8 with 3 points. 9
Wow.
7/8. I still have the rate sheet that cost me $500 to make because we didn't have computers. Right?
That's crazy.
Back in the donut days, right? The donuts and rate sheets. And and I go, you guys, share this with your clients, because relatively speaking, we are in a great position. We're still in a great position. We're not in a bubble. We don't have the same, statistics around. We don't have the same circumstances for a bubble. We're in a great position, and we're going to get back to normal. So what would you suggest to someone who is, now in this predicament, or not predicament, but in our industry right now? They're a loan officer in the industry. They're hearing you say this. They're hearing me say things. They're going, okay, so I'm getting really good at this market piece. I'm really excited because I heard that, now for the 15th time that rates are going to go down, but now I understand it and I'm going to really work on it. What would you be doing as a loan officer to ensure your position in the next wave?
Yeah, so I think this is like a challenging time compared to the last few years, right?
Mhm.
But it's still a good environment. And if you look at, absolute origination volume numbers, yes, they're down from 2020, 2021, but it's still like overall origination numbers, like almost top 3 of the last 16
Yeah,
years. So
yeah, top 4.
it's still a lot of business to be had. However, there's more challenges, but whenever there's challenges, it presents a great opportunity to gain market share, right? Because you can do things that your competitors won't. So
Yeah.
I would very much have a yearning for education, but also to be a teacher in this. And
Yeah.
in sales, in any relationship, I think one of the most important things is trust. And one of the best ways to build trust is simply with knowledge. So I would be providing a lot of value for my realtor partners, as well as getting out there and educating customers. And I think social media is a great avenue to gain business as well, and to really showcase your expertise. But those are some of the things that I would be doing. And I would also be counteracting a lot of the negativity that we see out there in the media, because the media is there for eyeballs and headlines, but there's so much out there that I think is currently scaring consumers about a housing bubble.
Yeah.
And people automatically, they remember the housing bubble in 07, 08, and they remember the recession there. And now there's a lot of talk about a recession today. But I think people make the mistake of thinking that the recession of 08, 09 caused the housing bubble. It was actually kind of the opposite, right? The housing bubble brought us into a recession. And as you said, things are totally different now, not just with the quality of loans being done. It's not your fog up a mirror anymore, right? Much
right.
stricter underwriting guidelines. We just got CoreLogic's loan performance insights. It's like
Yeah.
the healthiest and the lowest delinquencies in 23 years. People have record levels of equity, which they're going to protect before, going into a foreclosure or short sale. But what I really look at is supply and demand, because like in any market, that's going to determine price. And there's so many people out there calling for a crash. A crash should be like 20-30% decline in home prices.
Yeah.
I don't see that happening. I mean, we have still near record low levels of inventory, and demand certainly is not what it was. But I
But
still
it's
think
still
that we,
enough. It's
yes,
still enough that you don't see any homes on the market, I've seen
still,
an increase. I will say that I've seen an increase in open houses. That for me is always the telltale. Does the real estate agent have to sit in the house to try to get the house sold? Right. And I'm starting to see that more, although I would have been doing it anyway, because it's still client acquisition. But, but I am seeing a little bit more of that, which means that some homes in different markets, in different pockets, in different price ranges are starting to stay on the market a little longer. And again, that's because of interest rates and the fear for the clients.
well, I think also it has to do with listing your home kind of like on this planet, right? Because if you look at homes that are listed correctly, I mean, just look at the last National Association of Realtors existing home sales report. There's a lot of talk about less demand, which there is, and affordability issues, but the average time on market was 14 days, right? So if you have this
right,
home
instead of 7
priced
or 1.
good, if you have this thing priced good, then, accurately, then it will fly still. But I think a lot of this price reductions we're seeing out there is people reducing the price on their listings down to earth,
Chasing the
to what the
market.
home is more closely worth.
Yeah,
So
chasing the market. And I think some of that has to do with the greed, the greed and fear index. That's an index that I look at all the time, is the greed and fear index.
the
And
contrarian indicator.
yeah. I mean, that's really what it is. And I look at that, at least once a month, just to see where the flavor is going. And now they put out a chart for it, which is so good, because before they didn't have a chart for it and I couldn't compare. I was taking screenshots. But yeah, I think that that's changed somewhat. And, I think that's really helping us as well. So yeah, I love that, it's like, get out there. I call it edu-selling, right? I'm educating and selling at the same time to everybody that I'm talking to. And I think that that's going to be a key indicator for longevity. When the pandemic started, I kept saying, be careful of short-term gain for long-term pain. And I have preached that for 2.5 years now. And I will continue to preach that with my clients, is this short-term gain that you had, I had the best year ever, yada, yada, yada. It came from the market. There's a long-term pain that's in there. And I'm trying to help circumvent that for my clients, to shove that, but, push that back and say, it doesn't have to be as long-term if you are knowledgeable in this market.
100%. And, I want to be clear. I do see things slowing, right? But are we going to see 20% appreciation? No. But I think people don't realize, and the media certainly doesn't get this. I see them talking about the biggest price declines we've seen in a decade, right? And what they're pointing to is that the year-over-year appreciation number went from 20% to 17%.
Yeah.
Now, that doesn't mean the monthly number, by the way, was up 1.5%, right? So is a big distinction between home price appreciation slowing and home prices actually going down in value, right? So I think we're going to see a much healthier moderation of appreciation, where it's going to be mid-single digits, right? So let's just say it's going to be 4%.
Right. I was going to say 3.8. Right.
So I like, it's not 20%, but let's say it's 4% over the next 12 months.
Yeah.
I think it's important to educate your customers to the concept of leverage, because listen, if you're going to be living somewhere, shelter, you have 3 options. You can rent, you can buy, or you can be like Will Ferrell and Step Brothers and be living at your parents' house till you're 40.
Right.
So rents are going up double digits, and they will continue to do so. Renewals can go up every year. Your mortgage payment is going to be majority of fixed, right? And, not only that, but I just think that if you look at 4% appreciation, if you buy a $400,000 home, that means that let's say you put 10% down, kind of standard down payment, right? So, you're putting 40,000 down, and 4% appreciation means you gain $16,000 in 12 months. So what is that relative to your investment? it's a 40% rate of return.
Yeah.
And that's the beauty of leverage, which I think a lot of people don't understand.
Yeah. And right now we don't have opportunity cost loss because there's not much being paid in a regular account if that's where you're keeping your money.
Right.
So there's not an opportunity cost loss. There's an opportunity cost gain in buying a home. And it makes, complete sense. And that's something that I've been sharing with my daughter to share, in the market. It's like, you got to talk about opportunity cost. Stop hoarding this money that's not doing anything for you because
You're getting 0.06% interest from a savings
yeah. Well, I
account.
don't know. Mine I just got an announcement from mine. They're like, we're raising your savings account to 1.7. I was like, woo, but I don't have any money in the account.
Negatively yielding 8% for inflation,
Right.
so 7%
Right.
for inflation.
Yeah, that's exactly it. That's exactly it. Well, it's been fantastic, Dan. Thank you so much for sharing your wisdom with us and sharing some stats with us. I love talking this stuff because, I'm like knee deep in it myself. I love being an advisor, for loans. So I think that this is, right up my alley. And hopefully those of you that are listening and you're going, wait a minute, maybe this is too much for me because you're newer, then, re-listen to this and, do a transcription and take out some of the stats and start listening to them and using them in your conversations with your clients. So Dan, I want to ask you, what is the one thing that you'd like to leave us with? It can be a book, a quote, a mantra, an idea. What would you like to leave our listeners with?
Okay. I'm going to tell you a story.
Okay. A story.
My father told me.
Okay.
And it's a motivational story. And it has to do with how, listen, even though we're facing some challenges now, a lot of times the limits that we put on ourselves, the limits that we have in life are limits that we are self-imposed, that we put on ourselves, right? So, back before 1954, it was considered impossible to run a mile in under 4 minutes.
Yep.
So not just, in the sports world, but literally physicians said that it was physically impossible to run a mile in under 4 minutes. Now, in 1954, you had a gentleman by the name of Roger Bannister, who said, you know what, I don't care about what people say. And he went and he broke the 4-minute mile mark. Now, what was really amazing to me about this story is that once other people saw that it was capable of being done, that next year, several other runners went and broke the 4-minute mile mark. 7. I'm glad that you had that number, right?
Yeah,
so 7 broke it the next year.
Yeah.
So what that just shows you is that, oftentimes the limits that we place on our, that we have in life are limits that we put on ourselves. So, set your goals high, dream big, but work hard, obviously. And, you'll be really successful in this market. And then the last thing I wanted to just add is that, Jen, first of all, thank you so much for having me. It was an honor, and I hope that it added value to the listeners. But we do have a special relationship if you want to get information like we talked about today on a daily basis, and it's with MBS Highway. And I'll just share a slide with you really quick, but normally it's $200 a month or $2,000 a year. Because of the relationship with Jen, you guys have access to this for $129 a month or $12.99 a year. And if you want to sign up, you can either email my assistant, Christine, if you have any questions, or you want her to get you set up, or Jen, there is a code that we have set up with you.
Yeah, we'll have the link there. We'll also have the link for Christine. It's Christine with the CH. So CHRISTINE at mbshighway.com. You can just email her and say, Jen's discount. And they know who I am, so it'll work. It'll work. I promise it will. I promise it will. So we have your links as well, so people can follow you on social media and all of that. And I, again, I just want to say thank you so much, and be sure to say hi to Barry for me. I tried to. He was going to be I think he was in Vegas or something, and I said, hey, I'm going to be there too, but we couldn't connect for dinner. We were going to try to connect for dinner, so I haven't had a chance to talk to him lately. But say hi to him for me if you would. And I love what you're doing. Congratulations. I just wish you all the success in the world. It will continue to happen. I know it will for you. It's fantastic. It's been a pleasure having you on the show.
Thanks so much.
Thank you. And so everybody, please take a minute, just use your finger, scroll down to the bottom of your screen listening to this podcast, and write us a great 5-star review and give us some really wonderful comments about what you loved about Dan's conversation, what he had to say, because that is great feedback for him as well. It's great feedback for me. Please don't forget to go to Facebook and look for Mortgage Lending Mastery and join our group, be part of our group. We have some special things that are coming out in November because my birthday's on Thanksgiving this year. So we're going to be doing a special special thing for everybody who's in that group. So the more people we can get in that group, the better. And then don't forget to follow us and subscribe to my YouTube channel so you can watch and see the slides that Dan has shared with us today. You'll want to grab copies of them and do screenshots. So thank you again for taking time out of your busy day to listen to Mortgage Lending Mastery. And Dan, again, thank you so much for being here.
Thanks for having me.
Appreciate it.
Thanks for listening to Mortgage Lending Mastery. Be sure to subscribe to hear more sales tips, ideas, strategies, and tactics to help you with your personal and professional growth to multiply your results in record time. And if you like what we're doing, don't forget to give us a rating and review so we can continue to bring you the best content possible. Wanting more beyond the podcast? Join our Mortgage Lending Mastery membership community, where you will find extended interviews with our favorite guests, weekly training, tips, and insider secrets, fireside chats with Jen, free content, meet, share, and collaborate with other members, and so much more. Click the link in the show notes to learn more about this exclusive content. Mortgage Lending Mastery is an Industry Syndicate charter podcast. Industry Syndicate is the first podcast network specifically for the mortgage and real estate industries. Get the Industry Syndicate app in the App Store or Google Play today.